New rule. We want to have income tax avoidance. I mentioned that this strategy is perhaps the least well-known, least used of virtually any that is going to give your clients an incredible result. Incredible result. And the incredible result is, what is the normal result that one would have in a circumstance where the fair market value of an asset is, say, $3.5 million? Fair market value 3.5, and it's sold while both people are alive, a couple is alive, and they have a basis of $100,000. Right? The capital gain is $3.4 million, and that capital gains tax we mentioned before is 20%. Remember, this is AGI. You're going to be well into AGI with that kind of gain. Even if it's $350,000, right? You're going to be well into AGI. That's into this 23.8%, and I'm going to pay state estate tax here at 6%. It's just an arbitrary state. D.C., nearly 10%. Maryland, nearly 10%. All of a sudden, I have a third of these assets going out, or 30% anyway, for a total capital gains tax of $1 million on that kind of transaction. And the consequence of that is nobody's going to sell it. Probably. May not. At least they have to think long and hard. We talked a moment ago about, maybe doing installment sales or dealing with transactions to deal with this, but to delay that provision is a big thing. But what happens in states like California? What happens in states like Arizona, Texas, New Mexico, Washington, Idaho, Nevada? There are 10 states in the United States which represent roughly 30% of the U.S. population. That's a big swath of the U.S. population. Where if one of a couple passes away, they have a special set of rules. But here, large in the East Coast, the other 40 states, or 41 counting the District of Columbia, we all of a sudden have, if one spouse passes away and then the property is sold, I have a fair market value for the, I'm going to go back to one slide, this is the basis, here is only $100,000. So if I go here, a surviving spouse, if they own the property 50-50, the surviving spouse still has a basis of half the initial basis, that's $50,000. And even though I get a step-up or adjusted basis for capital gains purposes on the deceased spouse's half, on the survivor's half, the total tax is half of the tax on the previous slide. So on the previous slide, I had tax of $1,020,000. If one person died and then the property was sold, the tax would be $510,000. And oh, by the way, if the one that didn't own the property, let's say it was Jack's property and Janice passed away, there's no step at all. But in those 10 states, those community property states in the United States that have those rules, if one of the two pass away, no matter how the property is titled, no matter how it's titled, if it's in Jack's name and Janice passes away, or in Janice's name and Jack passes away, or at 50-50, it doesn't matter, there's a complete step-up in basis. Code section 1014B6 tells me if I'm in one of those states that has those rules, I get to have community property at 3.5. The deceased spouse's step up is 0. The surviving spouse gets 3.5, and there's 0 tax. 0.